Today we uncovered the 8 home loan banks offer, how they work, and which one will send you broke. In these tips, I'm going to show you how to get the most out of every home loan product. So keep watching. 1. A basic home loan. And this is by far my favorite. It's known by so many names by so many different banks, from the Simplicity, No Fee, Extra, Flexi, Essentials, Simplifier. These are just to name a few. Each bank tries to make it sound a little bit different and unique, but in the end, they're all the same. That is, it's 100% variable home loan rate with no fees and minimal upfront. Typically, a basic home loan only comes with the redraw and no offset. It's also very common for the banks not to allow construction or split home loans, which essentially means having a portion fixed and variable. So just keep this in mind if you are considering a basic home loan. 2. Introductory. This home loan is probably the one I like least, and it feels a bit like a bait and switch, and let me explain. An introductory rate, also known as a honeymoon, is a variable rate which offers a discount for a limited time only. It can be a little bit confusing as it does sound like a fixed home loan interest rate, but an introductory is a 100% variable home loan. Now let's look at how this works. Let's say you've got a bank offering a 2-year introductory rate. For the first 2 years, you'll receive a discount. Let's just call it 1% off their standard variable. But after the 2 years, it will decrease to, let's just call it 0.5%. So you can see here that for the first 2 years, you're gonna get a killer rate, but after the introductory period is up, you might find yourself with a raw deal. And this is the biggest problem, because if you've got a minimal deposit, that's to say less than a 20%, it might mean you'll be stuck. And because of this, if you refinance, it could mean that you might have to pay mortgage insurance again, in the end costing way more than what it's worth. So for this reason, I'd highly recommend you avoid this product unless you've got more than a 20% deposit. 3. Fixed interest rate. A fixed rate allows you to lock in your interest rate for a period of time. Typically, this is between 1 and 5 years. This means if you fix in your home loan for say 3 years, your interest rate won't change for this 3-year period. It's an excellent product for those who are looking for stability. But there are things to keep in mind if you are looking to choose a fixed rate. Firstly, most banks will limit how much you can pay on top of your minimum repayment. This is typically between $10,000 to $20,000 in additional payments each year. It also doesn't offer an offset or a redraw facility. So if you're looking to pay off your home loan quickly, you might want to have a split. Also, be careful, as if you leave early, it potentially will mean paying a break fee. Think of it like a phone contract. With the phone contract, if you leave early, there's a cost, and this is the same for a fixed rate. And finally, if you do take up a fixed rate, be sure you get an additional discount on the revert rate. This is a variable rate you'll go to once the fixed rate ends, and it'll really save you from being stung, and if you have a great mortgage broker or banker, they'll be able to help you do this. 4. Package. This is a home loan with all the bells and whistles. It's available for both fixed and variable. This product typically means you'll have to pay an annual fee. Generally it's around $400, and it'll allow you to have the offset, the redraw, and a free credit card. My biggest problem with this package home loan is that at a certain point, it'll become more expensive than its alternatives. And that's essentially to say that for the fee you're paying, it no longer justifies the discounts you're receiving. Typically this happens once you've got about $250,000 owing or less. But each lender is slightly different, and you'll really want to question this to make sure it's the right product for you. 5. Line of credit. So if you've ever been offered a line of credit or thinking about getting one, follow this advice. Run as fast and as far away as you can.
Run, Forrest, run!
This home loan will put you 6 feet under financially speaking. A line of credit is essentially a giant credit card. It's a home loan with an interest-only repayment, and it links to an everyday account. So essentially, a line of credit is a home loan, a savings account, an everyday account, and a credit card all bundled into one. I've never seen this work out well. I still remember refinancing a customer who had a line of credit for over 10 years. They hadn't paid anything off their home loan, they had no savings, and it's all because if money was available, they'd spend it. They never fully understood how this product worked, and to be honest, it's what every bank dreams of. Endless interest being paid forever. Line of credits are dangerous, stay away. 6. A global line of credit. Also known as a portfolio loan, this is a great product for investors. So essentially over time, it allows investors to remove bad debt, that's to say non-tax deductible, and in its place, replace it with good debt, also known as tax deductible. It allows for a global limit. So by paying off your home loan, it'll increase your investment limit. by the same amount. So over time, you'll simply transfer from your home loan to your investment debt. And the idea is that this new limit created each month can be spent on investments, such as shares. So over time, whilst you pay down your home loan, you'll technically be reborrowing the same money and increase your wealth via your investments. Long term, it essentially allows you to increase your good debt and your asset position. This strategy is also known as debt recycling, and if you're looking to implement this, it's best to get advice from an accountant or a financial planner. 7. Fixed interest in advance. This is another product investors love and allows you to get a year's worth of interest paid up front. Typically, this is really for people looking to reduce their tax in a given year. 8. Standard variable. You've all heard this product before, and it's simply the bank's benchmark interest rate. So if the bank's standard variable rate is 5% and you're on the package of, say, a 2% discount, you'd receive a 3% home loan interest rate. But here's the thing, it's very easy to get confused because some introductory and basic home loans are quite often not benchmarked against the standard variable. So if you're on a basic or introductory home loan which isn't benchmarked, and let's say the Reserve Bank of Australia may have increased the cash rate, whilst your bank may not have increased the standard variable and put it on hold, that might not be the case if you're on the introductory or basic home loan, as they're standalone products, not necessarily pegged against the standard variable. There you have it. Here at Hunter Galloway, we get home loans approved. So if you live in Australia and looking for a mortgage broker, we can help. Visit us online, huntergalloway.com.au, or call us on 1300 088 065. Which product did you like most? I'd love to hear your comments below. And until next time, I'll see you then.